Okay, let's dive in. Today, we're unpacking a really interesting story of corporate transformation. We're looking at the Sandur Manganese and Iron Ores Limited, semi-ore. This is a company with, what, a 70-year history? Deep roots in mining. But their recent strategic shifts, well, they've basically rewritten the script for the company. Our mission today is to get right inside their latest numbers. We're looking at their Q2 FY26 results, that's the period ending September 30, 2025, to really understand how this legacy player is pulling off its new strategy. They call it scaling new heights through integrated excellence. Kind of catchy.
Yeah, and that phrase, integrated excellence, that's really the core of it. For most of its life, Similar it was, a solid merchant miner. They're an established player, second largest for manganese ore, third for iron ore in Karnataka, and they've got leases secured out to 2033.
Solid foundation, then.
Exactly. But the big story, the real pivot, is this move from just digging stuff up to becoming an integrated specialty steel manufacturer.
And that pivot really kicked off with the Arja Steel acquisition, right? That was November 2024.
Absolutely. That was the defining moment. That acquisition it's the engine driving this whole new narrative.
You can see it straight away in the numbers, too. I mean, if you want proof this integration matters, just look at the consolidated total income for Q2 FY26. It jumped, what, 57% year on year? That's huge for a 70-year-old company.
It's massive growth. And yeah, it's almost entirely down to that steel business coming online, a total reshaping of their financial profile.
Okay, stunning growth, sure. But it came from a big acquisition, which usually means debt. So when you see that kind of acceleration, especially in mining and metals, you have to ask, is the foundation stable? What does the debt picture look like? Can they actually handle this?
That's a really important question. We'll definitely circle back to the balance sheet details later, but the strategy itself is designed to build resilience, to sort of mitigate that risk. Let's first look at what this integrated excellence actually means on the ground, like physically.
Yeah, good idea. It's definitely more than just ore heaps now. So lay out the scale for us. What are we talking capacity-wise?
Okay, so on the mining side, iron ore capacity is sitting at 4.45 million tons per year, MTPA. Manganese ore is just under 0.6 MTPA. They also do ferroalloys, SIM, and FEM capacity. There's between 95,000 and 125,000 tons per year. But the big one, the game changer, is the new steel capacity, 0.585 MTPA.
Right, and that steel capacity, that's the key to moving up the value chain, isn't it? This isn't just basic construction steel.
No, not at all. And what's really interesting is how they immediately focused on specialization. Buying Arjas didn't just give them a plant. It instantly put Smoyor among the top, maybe 5 players globally in high-quality, auto-grade, special bar quality steel, SBQs.
SBQ. Okay, so tell us, why is SBQ so important? Why does focusing there make such a difference compared to just, commodity steel?
Well, think about it. You're not just selling metal. You're selling specialized truss, really. SBQ is used in really critical car parts, axles, crankshafts, things that absolutely cannot fail. So to sell it, you need to be approved, like empaneled by the big global automakers, the OEMs.
Ah, okay, so there are high barriers to entry.
Exactly. That whole qualification process is rigorous. Bulk steel producers just can't easily jump into that market. It completely changes their competitive landscape. Plus, Arjas brought 2 different manufacturing technologies: the basic oxygen furnace, or BOF route, and the electric arc furnace, the EAF route.
Right, so that gives them the flexibility.
Huge flexibility. Depending on, say, scrap prices versus ore prices or the specific grades they need to make, they could choose the most efficient process.
And they're building that same kind of resilience into their costs, too, especially energy, right? I mean, miners and manufacturers, they just chew through power, but it looks like they've got that covered.
Oh, absolutely. Captive power is crucial for protecting margins in this industry, and their setup is pretty comprehensive. Arjas itself has waste heat recovery boilers, WHRB, that generate 32 megawatts, basically using waste heat from their coke ovens.
Okay, free power almost.
Pretty much. Then you add the renewed Sandur joint venture, that's a solar wind hybrid farm, another 42.9 millidB. And Arjas brought its own energy assets too, 20.4 millidB of solar, plus another 21 millidB from its own WHRB. It adds up.
Wow, okay, so when you put it all together, secure mining, specialized steel, and loads of self-generated power, what does that mix mean for, someone looking at this company's stability?
Well, the integration fundamentally de-risks the whole business. That's the idea. They have stable cash flow coming from those long-term mining leases, right? Protected income. And they use that cash to fuel the growth in this potentially higher margin specialized area like SBQ steel. The mining side acts like a buffer, an insulator. against the usual wild swings you see in the broader metals market. That's the integrated excellence thesis in a nutshell.
Makes sense on paper, but how did it actually play out in Q2? Management said it was a tough quarter, right? Seasonally weak, monsoons.
Yeah, they flagged that. The monsoon always slows things down in mining. And you saw that with iron ore production, it definitely moderated. Realizations, the prices they got also softened a bit, maybe 9% down compared to Q1.
But sales held up?
Surprisingly well, yeah. Iron ore sales volumes were still up 30% compared to the same quarter last year. So demand was clearly there, and they managed it.
Okay, but the real surprise, the number that jumps out, is manganese ore. You said realizations softened slightly there too,
Uh-huh.
but sales volumes went through the roof, up 335% year on year and 66% just from the previous quarter. How does a 70-year-old miner suddenly do that?
Yeah, that wasn't just market forces. That was regulatory. They got approval back in August 2025 to increase their permissible annual production limit, the PAP limit, for manganese ore in one of their main leases.
Ah, so they got the green light to mine more.
And they immediately ramped up production and sales to meet that new limit. They were ready to go.
Perfect timing then. Regulatory opportunity meeting operational readiness.
Hey.
Okay. Now, what about Coke? You mentioned that earlier. Their own production isn't fully back online.
Right, not fully. But they're using a conversion agreement for almost half their capacity.
Yeah.
And this is, well, it's pretty clever.
How so?
Because when they process that coke through the coke ovens, even under the conversion deal, they capture the waste heat.
Right, the WHRB tech.
Exactly. And that generates what they call incidental power. This power goes straight to their ferroalloys division.
So processing coke basically gives them cheaper electricity for making ferroalloys.
Precisely. It avoids buying expensive power from the grid. It's a direct synergy. You saw the result. The ferroalloys segment actually grew production volume quarter on quarter, again, mostly because they had more of this cheaper incidental power available.
Integration paying off directly in production costs.
Okay.
And the new kid on the block, the steel segment. How did Arjas perform in this tricky quarter?
Steel volumes held pretty steady. Marginal gains quarter on quarter, which is decent given the conditions. Management said the focus right now is on realizing those integration synergies we talked about and really pushing diversification.
So not just relying on the auto sector.
Definitely not. They're already RDSO approved. That's the Indian Railways standards body, so they can sell into railways projects. And they're actively targeting other high-spec sectors like energy and defense, trying to build up that non-auto customer base for stability.
That makes sense. Diversification is key. This kind of leads us away from just the numbers, though, towards the company's core values or philosophy. You know, a 70-year-old company often has a strong sense of legacy. There's that quote from the founder, M.Y. Gorpaid.
Ah, yes, the Sandur quote. All that we get earned from the soil of Sandur should be primarily used to benefit Sandur.
That really seems to guide them, doesn't it?
It feels like it. It seems to be the bedrock of their approach to, stewardship and community relations. And this ties back to the mining stability we discussed. Those protected cash flows from mining are what enable them to fund these pretty extensive welfare programs.
Can you give us some examples, like tangible things they do for the community there?
Yeah, the programs are quite specific and impressive. Take their food security initiative. They provide a food package for a family of 5, and the employee pays only, I think it's 145.
145 rupees. That's incredibly low.
It is. The actual cost is around 4,000. The company just absorbs the difference.
Wow. That's a massive subsidy. That makes a real difference to household budgets.
For sure. And another one, they offer a 90% subsidy on LPG cooking gas cylinders.
Okay, again, significant cost saving for employees.
Yes, but it's also environmental. The aim is to stop people cutting down trees for firewood. So it serves 2 purposes.
Smart. Welfare and environment linked.
Right. And then there's broader CSR supporting 14 schools, scholarships, plus a community health center, specialist medical camps. It's quite comprehensive.
And this commitment seems reflected in their environmental track record, too, with the mine ratings.
It is. They got the top rating, the 7-star rated mine recognition for 2023-24. That's the highest in the industry. And they've consistently held a 5-star rating for the last decade. That takes serious effort.
And they maintain a lot of forest cover.
Yeah, the number they quote is 88% forest cover within their mining lease area, over 1,700 hectares. It suggests they're actively managing the environment alongside extraction.
Okay, let's bring this back to the market and the financials. That explosion in the numbers we started with, that must be resonating with investors.
Oh, absolutely. The Q2 FY26 consolidated results are clear proof the Arjas integration is working, financially at least. Total income, 245 crore, up 57% year on year. EBITDA, 285 crore, that's up 211%.
211%.
Yeah. And profit after tax,
Hmm.
139 crore, up 242%. It's just massive acceleration, driven by adding that steel revenue and presumably starting to see those synergies.
Okay, and back to my earlier worry of the debt. How does the capital structure look after all that? Still robust.
It seems robust, yeah. The consolidated gross debt to equity ratio is 0.64, which isn't alarmingly high for this sector after a major acquisition. And if you look at the standalone mining company, it's even lower, 0.35. They've also maintained strong credit ratings, A+ stable from both CRISIL and iShares.
So the increased debt seems manageable,
It looks like the increased earnings and cash flow are comfortably supporting it. That's the key.
and the market seems to agree. They've hit some significant milestones recently, haven't they? Showing they're kind of playing in a new league.
Definitely. They passed the $1 billion market cap mark back in January 2024. Then, just in September 2025, they did a 2-for-1 bonus share issue, rewarding existing shareholders.
Right.
But perhaps the biggest signal was on October 14, 2025. Simayor officially entered the list of the top 500 listed companies in India by market cap. They ranked #494.
Wow, top 500. That's a major milestone for a company that started as essentially a regional miner 70 years ago.
Yeah.
That really signals the transformation.
It does. And management's own summary kind of captures it well. It said, despite the soft quarter seasonally, they delivered, quote, resilient performance across segments, strengthening efficiency and integration while positioning for stronger growth ahead. Sums it up.
Okay, so that really wraps up our deep dive into Semior. We've traced this journey from, a well-respected but traditional Karnataka miner to this emerging vertically integrated specialty steel player, all while accelerating financially and keeping those deep roots in sustainability and community welfare.
Yeah, I think the most striking thing from digging into this is just the speed and depth of the integration. It's less than a year since the Arjos deal closed, and they seem to have successfully meshed the stable mining cash flows with this higher margin specialized steel business. It's genuinely reshaped the company very quickly.
That speed and the way they seem to be using integration, especially that captive power to buffer against market swings, it leads to a final thought for you, our listener. If that core mining business really is insulating the newer steel segment from the usual commodity cycles, how effective will that focus on niche products, like SBQ steel, be in driving sustained growth, even if the wider economy or infrastructure spending slows down? And thinking further ahead, what other specialty markets, they mentioned defense, maybe aerospace down the line, could define the next stage of this integration journey? What does it take for a company rooted in the earth for 70 years to become a trusted supplier in those high-tech, high-trust sectors? Something to mull over.